Thank you for joining us today. I'm your host, Tracy Bennett. In studio with me are certified financial planners Stephen Lucan and Tony Payne. What's up, guys?
Not much. How are you?
Good to see you. Today, we're going to be talking about a subject that some people don't really have never heard of. They don't know much about pensions. So, before you choose your pension is the name of the topic. I want to be able to teach people what a pension is, how it's used, and throw some questions at you.
All right.
So the first thing is, and it was funny because we just had someone say, I don't even know what a pension is. And that's a common thing now because they're kind of considered old school, really. I'm aging myself, but I remember when pensions were a big thing, and that was, if a job offered a pension, that was one of the real reasons to take the job. So let's tell people what it is first.
Yeah, it's that promise by your employer to pay you when you're not working for them anymore.
Right.
I'm simplifying it, but basically it can be an annuity stream. There can be other methods of it, but basically it's that promise by an employer to say, we'll take care of you after you're done working.
So a part of your paycheck went to you and a part of your paycheck went to the pension benefit or your savings. It was an automatic savings account, basically.
Okay.
And it may not even have been you funding it too.
Right. For the most part, it
depending
was
upon
part of your compensation package.
Okay.
Yep.
So like a retirement account.
Yeah, it was. And in the old days, it was funded by the employer. And then all of a sudden it transitioned into your own responsibility, which is more modern, the 401k to 403b.
That was my next question.
And that's where the leap comes. It's definitely retirement account is not synonymous with it. A pension's more that retirement promise. So the idea that there was that big shift in the 80s from retirement promises to retirement accounts, and it really put it on you. It put it on you, the individual, of, am I saving enough? 401ks became more prevalent. You know, the idea of where pension shifted away, but that was the promise by the employer to pay. And, you know, we saw a lot of businesses that changed. Mm-hmm. Maybe they had a lot of a lot of employees at one point. Things changed and they couldn't support the pensioners anymore. Mm-hmm. So that's the downside sometimes of that promise rather than having your own account where that's my money.
Yeah.
So back then they were a promise. Now they're structured.
Yes. Yeah. But it's funded by your own money these days with the 401k and 403b versus the company money.
So 401ks are considered pensions.
No.
Right. Those are where we go in the difference. And I may have conflated them here.
We don't need to get there.
No, you're
just
the alphabet
my
soup.
lay mindset just kicked in.
Yeah. No, because they went away because they're very complex. They're very hard to manage. I mean, a lot of them have gone bankrupt.
How are they managed?
By a bunch of big investment firms that are great. I'm going to be direct here because I have family members too. I mean, you showed up, you did your work, you did your 30 years, you hit your promises, but these big banks or investment bankers made, dare I say, pretty greedy investment decisions. So either it was 2007 or 8 or even the late 80s when there were big corrections in the market. Well, oh my gosh, our pension's underfunded. Well, you were also trying to outperform all the time too. And if you had been in bonds or cash and maybe a more modest return and given yourselves the time to recover, I mean, we know what the market's done since 07, 08. We know what it's done since 88. I mean, the idea that a pension just couldn't work, no, it really, again, it was the idea of, dare I say, pushing the responsibility back on that employee who did their 30 years.
But it was also the industry too, right? You look at the steel industry. Bethlehem Steel was one I remember back in the 80s that the pension went bankrupt, right? Because it was the steel industry. Or the auto industries, was it Delphi?
Yep.
They went, I think they lost their pension, went bankrupt. Some airline pensions went bankrupt. So again, these are industries we all know of, but if they're mismanaged and the industry itself has challenges, it was very risky, very risky.
And again, the idea of where that pension money's invested and how, again, that's where in theory it's its own trust. So the business could go bad, but when you're taking that savings and putting it aside, well, the business could go under, but the pension should still be there. The idea was they kind of rated the pensions on their way down.
Right.
And that's the downside if you're that 30-year employee who's looking back going, my promise was this, and I'm getting 2/3 of that promise. That's what happens when they go bankrupt. The pension goes under.
Yeah,
that's interesting.
If you're lucky.
Yeah,
I remember it would have been 1984.
It's a good year.
It was a good year.
It was a great year. Just starting out in my first career, and I remember this so vividly today. We had a gentleman that worked for. He oversaw quite a bit. He had a huge amount of responsibility. I remember the day he lost his pension. those were his words. After 40 years, he lost his pension. I didn't understand really what that meant because I was super young, but I think about him all the time.
Yeah.
And I remember the look on his face, and I remember, the it was supposed to be a guarantee for life.
Yeah. Well, he didn't lose all of it. It was probably insured. What is that? PBGC?
The pension benefit guarantee.
Right.
Okay.
And it's an insurance, but you lose a portion of it. You're still losing some of your money
Right.
that you were promised because basically it's being taken over by the government. My grandfather went through the same thing. He was a furniture maker, woodworking. Again, all those jobs in the 80s went overseas. His pension went belly up and he lost a portion of his pension.
If you remember the movie Wall Street, they talked about, we're going to sell off the hangars for condos and hit the overfunded pension. And these were the real conversations. And on the other side, there's government pensions too. And we haven't talked about those a lot, but those are funded.
Are more modern.
Yeah, exactly. But those have been around too. They're just still around.
Right. They're still around.
And the idea is they can be funded with the power of the taxpayer, the power of long-term thinking and not being on that short-term side. So again, we see more and more of those in institutions, healthcare, universities, governments. That's where you really see a lot of pensions today.
Sounds like you have more control if you go outside of that sort of tool. But
you do, but you got to be careful. You have control, but you also have control. You assume risk.
Okay.
That's where most people, that's what Tony was talking about, the risks of the pensions took. If you're getting too greedy, you invest in the wrong areas and you could make the pension vulnerable. Same thing with your...
So the company's assuming the risk.
Right? Yes, exactly. Because there are a lot of good, even today, I mean, again, the pension I was a part of, Hilton Hotels was my first job. And they just ended the pension. They just paid it out and gave me it into my rollover. So there are good companies that have pensions that work. But when you sign up for a 401k or 403b, you're assuming the risk of the investments because you have to, and then also the distribution. When you get a pension, you're getting a fixed benefit. I could raid my 401k day one and spend it all. And then I can say, I have no money. They took all my, no, you spent all your money. Right. So it's all assumed risk.
Yeah. The idea of, again, I've lost my retirement. You hate to hear that. And you hear it sometimes often, and depending upon the economic cycle, and you have to ask why. Again, not to the person, they're going through it, but was it I sold when the market was all down? I was over concentrated in my company stock. Maybe it wasn't a 401k, but you still owned your company stock there. That happened to a lot of Enron employees or WorldCom. But then the other side of, well, what if the pension just went under, or I'm sorry, the company went under that sponsored the pension? In that case, you keep your 401k and hopefully you might have diversified outside of that. Maybe you still are okay. Maybe you've saved enough that, I'm on to the next company, or I was there long enough, I'm okay. And that's a lot different than, I counted on this pension. They kept giving me the statement. It said I'm going to get this. I'm not getting that. That's what I built my whole life on.
Right.
That's rough.
Right. Yeah. This is a very deliberate question. What problem is a pension really designed to solve, and what problems does it quietly leave to the rest of your plan?
Well, it solves a lack of income when you retire. Right. So it provides an income stream. And that's the number one thing is why it was designed is, okay, once you're no longer able to work because you're too old. Yeah. Right. So you have to retire. Here's money, right? Here's money for your retirement. And then you add that and then plus Social Security possibly. Some may or may not, but whether or not you qualify. So it provides an income stream for your retirement years. That's what it solves.
Yeah. And the other piece, maybe the problems or what is it set up, depending upon the amount of pension, which it could be a problem depending upon your plan. Maybe you've saved enough. Maybe you sold a business. Once you've turned that pension on, maybe you're in the highest tax bracket every single year. Again, maybe it's not the worst problem to have, but with planning, maybe you could have done that a lot differently. Maybe you could have been more deliberate in when that money came out or set it to heirs. But that pension stream, depending upon your tax rate, each and every single year, that may be adding up. So there might be a tax problem associated with it. There also might be inflation. The idea of depending upon how the pension's set up, it may not grow. We've seen it. It's kind of shocking here with recent events, oil prices through the roof, but the stock market also doing okay. Yeah. And the idea that, there's inflation protection sometimes in the stock market, that's what we might be seeing.
And that's a really good point. If you think about it, let's say you retired 10 years ago and you got $2,000 a month. You could buy a lot more then, and if there was 0% inflation on your pension benefit, try to get $2,000 a month now.
And see, that's something that the rest of us don't think about. That's something that's not even
right
in the conversation.
Right. So inflation is a huge risk. So you have to check whether or not your pension benefit inflates or not. So that's where taking it early, if there's no inflation on it, that's a very, very dicey situation.
And you see that a lot on the coast with those higher cost of living states where maybe you were a service employee or you worked for the state, and the idea that your pension is not growing nearly what that high cost of living area, LA or New York or Denver, something like that. Each and every year you've got this long-term family house, you love it, but everything else around you is growing more and more expensive, outpacing your pension. That can be real. And again, just be mindful of that. Know it. Do your math ahead of time.
Awareness is half the battle.
This may be a dumb question, but can you, when you're working for a company that offers a pension, can you elect not to participate? Or is it just an automatic part of your retirement?
It really depends on how the company's set up. And that's a great question, because sometimes you'll have people where they are offered a pension and maybe a deferred compensation plan, maybe still a 457 or a 401k, all these letters out there. But the ability to say, yes, I get this promise, this pension, but I can also save on my own. And that's what we think is sometimes a great approach.
So be diverse. Be diverse.
Yeah, I think so.
Yeah,
I think so.
Do you take distributions on a pension?
No, it's
or
an
is it
income
just
stream.
an automatic?
It's a payment stream. Yeah,
at a certain age.
The risk. You're set up with this income stream. You have to manage the income stream. The company who's providing the pension has to manage the risk of the investments and the commitment to that pension stream to all the employees.
Okay.
Right.
So much like Social Security, or if you're getting a distribution and you don't really need the money, you can reinvest it. Can you?
Sure.
Can you reinvest that?
Sure.
So with that, again, it depends on the pension plan, because some of our state employees, they'll even have what they call a drop account, a direct reinvestment of pension. So the idea that you might be able to put it aside and invest it, maybe you got rehired. A lot of departments are doing that now, where you were able to retire. Maybe you don't need that money. You're still going to get paid. Well, having a pension, sometimes nice, having that extra income. But if something happens to you on the job, maybe it stops. So the idea of, if I could take that pension payment and just have it go in an account for me, what a wonderful thing. Then it's growing like it's in an IRA. And again, do you even know if that's available to you? That's where getting the document, working with an expert, hopefully you can figure out what your options are. Maybe you want to keep working and it makes sense to retire. These are the kind of questions to ask.
Okay. What kinds of things that can go wrong if somebody is just relying, if you're just relying on Social Security? Okay.
Let's hope not. Right.
Right. Same concept. If I'm just relying on my pension, is that good, bad?
Well, it always depends, but it comes down to the cost of living and the structure of the pension, as we talked earlier about the inflation aspect. Does it have an inflationary increase every year? That comes that you assume that responsibility to manage your finances with that pension benefit.
Mm-hmm.
So you could live in a tent somewhere in the middle of the wilderness, or you could live in a high rise in a major city. Can you afford it? I mean, that's really what it comes down to.
Will it be enough?
Will it be enough?
So it's subjective.
Yeah.
And again, exact scenario. I mean, you think about the same factory. I'm thinking of one here in Columbus that unfortunately is now where the casino is.
Right.
It used to be a General Motors factory, then a Delphi factory. You could work there from the 50s on and have a wonderful pension for 40 years almost, and have never had a care in the world, gone to golf every day, passed away, and life was great. And if you're on the back end of that, they spun it off to another company, maybe moved some jobs overseas, and then all of a sudden that company declares bankruptcy. Your pension, that Delphi pension, looked a lot different. Yeah. I mean, everyone's a little different where they were, but the idea that it's the same building, same jobs, just two different scenarios, same pension.
Decades.
Yeah, exactly.
Right,
and that's
retired.
Where that lack of control sometimes comes in with a pension.
Mm-hmm.
Yeah.
We talk a lot about estate planning. We have a lot of podcasts about estate planning specifically. So our pensions, can you beneficiary somebody?
Great question.
Your pension?
Yeah, hopefully you can, but that comes down to the benefit. That's, again, when you elect to receive your pension, one of the questions may or may not be is, do you want to have a beneficiary listed, and what would their benefit be? And based on the survivor benefit,
okay,
what you choose would affect the pension benefit. So example is I get $2,000 a month, but if I have a beneficiary, my spouse, and I want her to get 100% of what I'm getting, that $2,000 a month might be $1,500 a month, but it runs through both of our lifetimes. Right. Wow. So it might be a reduced benefit. You could sign up for 20. It's an alphabet soup of choices. But again, understanding and playing it out is very important.
That's pretty nice.
Right. And that's where the math really comes in. I mean, you think about, couples where maybe somebody's 10, 15 years older than someone else. Well, then that math of how does this pension look or work,
right,
it really comes into play on maybe that beneficiary election is a wonderful choice, maybe not. But right. Again, you've got to consider those numbers too.
Yeah, consider the numbers.
Okay, another deliberate question. And you pretty much, you started the conversation, but I want to make sure there's nothing left on the table. Timing, inflation, and purchasing power. So the check looks great today, but how should people think about what it buys 15 or 20 years from now? Can you increase? So there's no contribution per se. It's just money that.
Correct. Okay. And hopefully maybe you have a surplus, to Tony's point earlier, with you could maybe roll it in and reinvest it. But let's say you get $2,000 a month and you're spending only $1,500, save the $500. Don't just squander it, right? Build a plan around it if there's no inflation. So you have to fight.
That's the key.
Right. You have to fight inflation internally with yourself in your own finances. So again, knowing what your benefit is, knowing how it works, and you'd be surprised what a lot of the pensions I've seen over the years, a lot of the information is lacking. Yeah. You have to ask these questions, and it's like just an inflation.
You don't know what to ask if you don't know what to ask.
Right, but a lot of the times it's not even provided.
Yeah.
And you have to
live through that.
Right. You have to ask multiple people and say, is there inflation rider on this benefit?
To take that example, Stephen, with you, and you might be thinking about disability insurance.
Sure.
Again, outside of a pension, but you see that line item when you get hired. It says benefits included. Do you ever ask any other questions? Do you ever get anything else?
We're actually going to do a podcast.
All right. Well, I'll leave that for that.
But the devil's in the details.
If you just take it for granted, disability, okay, that's it. No, what does it say? What does it mean? How does this apply to me, my paycheck? Maybe I'm on bonus or commission more than salary. Maybe it only covered salary. I mean, these are things for disability, but they apply in the pension just as well.
Yeah.
And that's kind of a segue to my next topic. How does health play into your pension choice or your ability to take a pension?
I think that's where you tie in the beneficiary aspect, right? If let's say I have a pension and I'm not in good health, my spouse is, she's going to live a lot longer than me, I might want to make sure there's 100% survivor benefit. Okay. Because it could die with you too. If there's no survivor benefit, the minute I'm gone, pension's gone. Right. So you have to, that's why you have to understand if there is a survivor benefit, what is it? How does it apply? If there's any adjustments as well.
We talked about how guaranteed it really is. Did we leave anything off the table in that conversation? When somebody hears guaranteed pension, what should they look at to understand how solid that promise really is?
Aside from just the annual funding reports, which they're required to do now and say how well funded's the pension or not, the other thing to look at or consider is how's inflation built in here? Maybe the pension's solid and it's there, but depending, even government pensions, it might require an act of their government or Congress, depending upon how your pension's set up, that may tie into how it grows with inflation, or it may not be there.
Do we want to consider Social Security a pension?
Sure. That was actually...
And that's our biggest joke in society.
Yeah.
Right? When's it going to all go belly up?
Right.
About the time we're ready to collect. Right?
Oh,
I think I'm about 10 years older.
No, I don't think so.
You're a baby. You've got time. I am panicking because it's right here.
Well, we'll talk about those solutions, why that won't happen now.
Right.
I mean, that's the... I'm
optimistic.
But it's out there. A lot of people talk about the bankruptcy of Social Security.
It'll just look different.
It's out there, but that's how you have to look at it if you have a pension. How vulnerable is it? It's real, right? Because it's a promise to you, an income stream.
Are pension decisions hard to undo? So if you make a decision about survivorship benefits or anything like that?
Yeah, they're pretty much permanent. I mean, they're almost permanent elections. The idea, unless there was fraud or abuse, something like that. I mean, that's these extreme examples. So not to be never, but they really have to be extreme examples to go back in time.
They may require a notary when you're signing it, right?
What are some of the selections?
What do you mean?
So you could elect a single life stream.
Yeah.
Pay me for the rest of my life while I'm alive. Usually, a reduced amount would be pay me and my spouse. Sorry. So if something happens to me, my spouse could either get the same amount. Say $1,000 is what I get, they get 1,000 too. Well, that's one benefit, or even maybe they get 25%. I mean, there's all these different flavors. Some of them maybe even for a period of time. You know what? No matter what, your family's going to get it for 5 years, 10 years, 15 years. So there's really no shortage of options. And that's where, depending upon the pension and your situation, sitting down to say, what's best for me, it's always different.
Yeah. Because what if your spouse is older, 10 years older?
Why would somebody pick 25% of the pension amount for your spouse when they have an opportunity to
Maybe
take
the
100%?
spouse doesn't need the money.
You behaved badly.
Right,
I'm
because
not going to
it's
give you
all an
100%.
adjustment, right? But it's all an adjustment. So that 25% benefit gives you a larger benefit. What if my spouse is 10 years older than me, and the chances of them predeceasing me is greater?
Okay.
Give me more money. We both benefit from it, but there is that risk. But it's all variable.
Yeah, I was using some numbers there. So the idea of if it were myself and my spouse, that same $1,000 a month, for both of us to have that certainty, we give something up for that. And if we give something up, it might have been $1,500 if it was just for my life. So the ability to say it's 1,000 is 1,000 no matter what.
Mm-hmm.
So that's where, depending upon your plan or the amounts, you know what, maybe 25% is enough between their Social Security or their whatever is in their plan. So that's why it could be unique. But you know what, maybe that bigger amount, when I'm doing my math, it's not worth it for me.
Offspring aren't eligible for pension
I don't
benefits.
think you can do a
right?
non-spouse. Maybe I don't think.
It depends on the
Yeah.
type of pension, because the government ones will typically allow you to add a non-spouse. So I think, again, of some of the state pensions, if you're in law enforcement, firefighting,
Okay.
things like that, where you might be able to list a non-spouse, and then they'll do the math based upon their age.
Right.
So especially if you might be in a divorce situation or minor children, knowing that and selecting those options could be really important.
Yeah. Wow.
Yeah.
That we really unpacked it. Thank you. That was interesting. We hope you like and share with your friends. And remember that a pension isn't just a benefit, it's a strategy, right?
Exactly.
We're looking at.
Yep.
Thank you.
Boxland Media. Think big.